are at or beyond full employment. And so it is not necessary for the economy to grow as rapidly as it has been growing. There's a risk of recession, but it certainly isn't, in my view, something that is necessary to bring inflation down.
That was Treasury Secretary Janet Yellen in an interview yesterday with 60 Minutes on the state of the economy. Inflation still dominating investor sentiment as the market hopes to recover from a rough ride last week. And for a look ahead of what to expect, let's bring in Max Kettner, HSBC Chief Multi-Asset Strategist. Max, great to have you here with us this morning, and thanks for taking the time. When you hear about what Yellen was saying and really kind of read through what this means for the employment situation and even going into next year, what most notably sticks out to you?
I think most notably what sticks out to me is that pretty much everyone is expecting a recession in the first half of next year, right? You were in the previous segment mentioning a couple of year ahead outlooks across a couple of brokers, a couple of banks. I think it's pretty much consensus that the first half of next year is going to be pretty tricky on the growth side. Perhaps we'll get a recession. You were debating about the severity of recession. Is it going to be mild? Is it going to be short? Fine, but I think overall the opinion really is, and the overwhelming consensus opinion is that the first half of next year is going to be really challenging from a growth perspective, and thereafter we're going to get a recovery. I think the risk, actually, going back to perhaps to your previous segment, the risk really is that perhaps that sequencing is going to be turned around. Again, you were mentioning a couple of risks. All the risks that I'm seeing that I mentioned right now are actually only downside risks. I don't really see an awful lot of people talking about upside risks, about what could actually go right. Like, is there a way where we could delay the inevitable, even if it may not be inevitable, but perhaps delay the recession another 2, 3, 4 quarters, for example? I think that really sticks out as this underlying bearishness that we've got at the moment.
So, Max, if that is the case, and everybody is on this gloomy bandwagon and thinks it's going to happen around a particular time, from a positioning perspective, what is the risk? In other words, is everybody sort of doing the same trade right now? And if so, what are the risks and opportunities that rise from that?
I think, I think there is more and more crowding from consensus, right? We've got basically people saying, oh, you've got to be probably going into bonds, and bonds offer more protection now and more of yield now. So 2023 could be the year of fixed income and the year of yield, but just don't bother with equities at all. Don't bother with high yield. Don't bother with any of the risk assets. I guess from my point of view, the one thing that really does stick out is that, yes, leading indicators are unanimously pointing lower, but we still have an awful lot of excess savings. We still are faced, actually, we look at the last 6 to 9 months, in the face of this energy crisis, we're faced with an enormous spree of spending again from the fiscal perspective, right? Who would have thought 12 months ago that, we get another couple of $100 billion of fiscal stimulus in the US, Germany spending, France spending, the UK spending. So, we get in the developed world an awful lot of more fiscal stimulus that then again is softening the blow. I guess from a positioning perspective, the crucial question then is this either going to go into Goldilocks, i.e. are we going to see positive activity surprises on the earnings and on the top downside coupled with falling inflation? Because that would inevitably basically mean a 2019 style of environment where you go short the dollar, you go long duration, real yields fall, and you just buy anything you want, right? It's a Goldilocks environment where you say short cash, short dollar, long growth, long carry, right? A really, really benign environment across almost all asset classes. I don't think that is going to be very likely. I think if we are going to see actually a bit of positive activity surprises, the more likely outcome is going to be that at some point we're going to get a few positive inflation surprises again. And on the back of that, that actually means a bit of a repeat of what we've seen in the second quarter and August until the beginning of October, namely pain across the asset classes. Growth equities going down, right? Yields going up again. So bonds and equities and high yield credit and pretty much all major asset classes suffering again with a sort of final push higher for the dollar.
At what point, Max, do you see investors starting to position for rate cuts next year?
Oh, I think they do already, right, Lauren? When we look at the second half of next year, we already got a couple of rate cuts in there, and it gets even more dramatic than in 2024. That perhaps is one of the reasons as well why I think that Goldilocks scenario is unlikely, because the rates market is already pretty much positioned for that. If you look from the middle of 2023 until sort of middle of 2024, September 2024, you've got about 150 to 175 basis points of rate cuts being priced in already, right? Starting in the second half of next year. And that to me looks very unlikely. Why? Not because of the timing or the severity, but because of the sort of magnitude and the timing around it from 2024. If indeed we are seeing a recession next year, it's unlikely that most of the rate cuts are starting somewhere in 2024, but they'll actually have to start next year, right? Or on the other hand, if activity data really continue to surprise to the upside and inflation then proves to be a bit more sticky, then those rate cuts that are being priced in from the middle of next year until middle to third quarter of 2024, those rate cuts are very, very, very unrealistic. On both ways, it's pretty bad across the asset classes, really.
Well, 2024 can't get here quick enough. HSBC Chief Multi-Asset Strategist Max Kettner, always good to see you. We'll talk to you soon. Happy holidays.